From Semiconductor Cycle to Energy Supercycle by Value and Momentum Portfolio. Independent research with catalysts to watch and actionable insights. For informational purposes only. No investment advice. For about 2 years now, the AI investing story has been told as one thing: chips, GPUs, NVIDIA. And honestly, that story made a lot of people a lot of money. But here's where it gets interesting. That story's already out of date. The real bottleneck in AI isn't silicon anymore. It's electricity. It's the wire, the transformer, the gas turbine, the substation. It's the very ordinary, very physical machinery that turns a molecule of methane in the ground into an electron, arriving at a chip somewhere in a warehouse in Virginia. So today I want to walk you through how I'm thinking about this. We're going to reframe AI from a semiconductor cycle into something bigger, an energy and infrastructure supercycle. And by the end, I'll give you the names in order that I think matter most. Let's get into it. Part 1. The reframe. Okay, let's start with the headline shift. For years, Wall Street has treated AI as two separate trades. There's the silicon stack, chips, foundries, the clouds that rent them, and then there's the energy stack, turbines, switchgear, cooling, the contractors who put it all together. Different analysts cover them. Different funds buy them. Different ETFs slice them apart. That separation is wrong, and it's breaking down right in front of us. Here's the number that frames everything. Hyperscaler CapEx, that's Microsoft, Meta, Google, and Amazon, is tracking toward roughly $725 billion in 2026. $725 billion. And the marginal dollar, the next dollar out the door, is increasingly not going into accelerator chips. It's going into the physical machinery that keeps those chips running. And this shift happens in two phases. Near term, through 2027, the winners are natural gas, on-site generation, and grid infrastructure. Why? Because hyperscalers need electricity right now, and they cannot wait the 5 to 8 years a typical utility connection takes today. Longer term, from 2028 onward, nuclear and advanced baseload power become the backbone. Because at some point, intermittent renewables and even fast-deploy gas just can't carry the load anymore. The bottleneck-migration. Now here's the single most useful idea in this whole framework. Track where the binding constraint sits over time, because capital flows to the constraint, and the constraint moves. Watch this pattern. In 2023, the bottleneck was GPU supply. NVIDIA captured the rents. In 2024, the bottleneck moved to high-bandwidth memory. Micron and SK Hynix benefited. In 2025, the constraint shifted to grid equipment. Medium and high-voltage transformers used to take about 50 weeks to deliver back in 2021. Today, over 120 weeks. Gas turbines from GE Vernova are sold out through 2028. Interconnection queues at PJM, the biggest U.S. grid operator, run 5 to 8 years. By 2027, the binding constraint becomes generation itself, which is why behind-the-meter nuclear and small modular reactors are now real investment categories, not science projects. And here's the part most people miss. The equity market is consistently slow to price this in, 6 to 18 months slow. So if you can see where the bottleneck is migrating to next, you're effectively looking around the corner. A quick primer on AI power in plain English. Before we go further, let me make sure we're all speaking the same language, because some of this gets technical fast. An AI data center is basically a warehouse the size of several football fields, packed with rows of tall metal cabinets called racks. Each rack holds servers, and those servers run on AI accelerator chips, mostly NVIDIA GPUs today, with smaller shares from Broadcom, who makes Google's TPUs and AMD. Here's the thing about these racks. A modern NVIDIA system draws about 120 kilowatts. That's the continuous power of roughly 100 American homes per rack. And the next generation, called Rubin, is being designed for 250 kilowatts a rack. A single AI data center can hold thousands of these. That's why people stopped talking about megawatts and started talking about gigawatts. 3 engineering problems follow from that density. 1, you have to get that much electricity to the building. 2, you have to step it down through transformers and switchgear inside the building. And 3, at this power level, you can't cool the chips with air anymore. You need liquid cooling, coolant flowing directly across the silicon. Those 3 problems define most of the energy investment landscape. On the chip side, there are a few choke points you should know. Synopsys and Cadence are a duopoly in design software. TSMC makes most of the advanced chips. ASML in the Netherlands is the only company in the world that makes the extreme ultraviolet lithography machines needed for the top-end stuff. And the memory that sits next to the GPU, high bandwidth memory, comes from Micron and SK Hynix. Most of these are sole source, which is why semiconductor geopolitics gets so intense. And on the energy side, here's the key concept. When a hyperscaler can't wait years for the utility to extend a line, they bypass the grid entirely. They build power on site, either gas turbines, basically jet engines burning natural gas, or they sign a deal with a nuclear plant operator next door. That's called behind-the-meter generation. Amazon did it with Talon at Susquehanna. Microsoft did it with Constellation at 3 Mile Island. Those deals are the canary in the coal mine. They tell you the bottleneck has gotten so acute that the biggest buyers in the world are engineering around it. Part 2, the 4-layer power stack. Okay, with the vocabulary in place, let me walk you through how to think about the energy side. It's not one trade. It's 4 layers stacked on top of each other, and each layer has different winners. Layer 1 is natural gas supply, the fuel itself, the molecule, the pipelines that move it. This is the most undercovered layer in the entire stack. EQT, the largest U.S. natural gas producer. Kinder Morgan, Williams, Energy Transfer on the pipeline side. Here's why this matters. These names sit 1 layer upstream of gas turbines that are already sold out through 2028, but they're covered by oil and gas analysts whose models do not include data center demand. So the pull-through is real, but the consensus hasn't caught it yet. EQT in particular looks structurally analogous to where GE Vernova was in 2024, just before the market figured out that data centers had quietly become the dominant story in its order book. Layer 2 is on-site generation. This is the live bottleneck right now in 2025 through 2027. GE Vernova, heavy-duty gas turbines. Siemens Energy, Mitsubishi Heavy. Howmet makes the blades that go inside those turbines, and there are only 3 companies in the world that make industrial gas turbine blades. Howmet is the only public independent, so it's an oligopoly. And then on the second derivative side, you've got Bloom Energy doing fuel cells, and Kodiak Gas Services doing compression and mobile power. Layer 3 is the grid equipment that has to catch up. Transformers, switchgear, the wires themselves. Eaton, Vertiv, Hubbell, Emerson, Powell on the equipment side. And then the contractors actually installing all of this. Quanta Services, MYR Group, Comfort Systems, EMCOR. These are the EPC names: engineering, procurement, construction. Quanta especially has a $35 to $39 billion backlog, and the multi-year master service agreements with utilities are getting longer. Layer 4 is nuclear, and this layer splits in 2. There's the existing fleet, Constellation, Vistra, Talon, which is benefiting today, and then there's the new build, Oklo, NuScale, Nano-Nuclear, which is pure optionality for 2028 and beyond. Let me give you a number that makes the nuclear story click. A behind-the-meter PPA, that's a power purchase agreement, sells electricity to a hyperscaler at $80 to $100 per megawatt hour on a 25-year contract, versus selling into the wholesale grid. That implies a per kilowatt valuation of the underlying nuclear asset of roughly $4,000. The market today is capitalizing wholesale-only nuclear plants at about $2,000 to $2,500 per kilowatt. So a behind-the-meter PPA roughly doubles the implied value of the same nuclear asset. That's the whole trade in one number. The risk on this is FERC, the Federal Energy Regulatory Commission. In November 2024, FERC rejected a key amendment to the Talon-Amazon contract. That decision is still the swing factor for whether the BTM nuclear thesis works at scale. Keep an eye on it. One more cross-layer observation. GE Vernova is the only company that spans both Layer 2 and Layer 3. Heavy-duty turbines on one side, grid solutions on the other. Same hyperscaler customers, consolidated backlog around $150 billion. That two-layer franchise is why GEV's backlog has compounded faster than any single-layer competitor. Beyond 2027, the three forward tracks. Now through 2027, the migration is linear. Chip, memory, grid, power, transmission. You can read it off the order book. From 2028 onward, the simplicity breaks. The constraint doesn't stop migrating. It splits into three parallel tracks. And critically, the winners in each track are largely different from the winners in the current cycle. Track 1 is inputs and materials, the raw stuff this build-out consumes. 4 sub-bottlenecks here. Water, because liquid cooling drinks materially more water than air cooling, and water rights are now a binding siting constraint in Phoenix, Northern Virginia, and Dublin. The beneficiaries are Xylem and Veolia in water treatment, and Vertiv in immersion cooling, which uses a dielectric fluid in a closed loop and sidesteps the water problem entirely. Second sub-bottleneck, nuclear fuel, specifically a fuel called HALEU, which is uranium enriched to between 5 and 20%. Most advanced small modular reactor designs need it. Russia controls the largest share of global enrichment. The only U.S. producer is Centrus Energy, with a demonstration cascade in Piketon, Ohio. Cameco for mining. BWX Technologies for fabrication. Third, electrical steel, the magnetic core inside every transformer. The U.S. has effectively one integrated producer, Cleveland-Cliffs. Fourth, rare earths, magnets for motors and generators. China processes roughly 80 to 90% of global supply. MP Materials is the only fully integrated U.S. producer. Lynas is the leading non-Chinese alternative. Track 2 is labor, and this one's important because it doesn't show up in any backlog. The U.S. is structurally short of skilled electricians, pipe fitters, and mechanical technicians. The shortage is in the hundreds of thousands of workers before the AI build-out even started. And union apprenticeships take 4 to 5 years. You can't fix this with CapEx. You can't fix it with money. It takes a decade. What does that mean? Two things. One, the traditional on-site contractors face margin pressure from wage inflation. Two, the companies that have actually built a factory labor model start to dominate. The prototype here is Comfort Systems in its Summit Industrial Construction subsidiary, which prefabricates entire electrical rooms off-site and ships them in. IMCOR, Limbach, API Group all play in this space, and Will Scott Mobile Mini on the modular structure side. Track 3 is the deepest one, and it doesn't even show up in CapEx tables yet. It's the shift from training to inference. Quick distinction. Training is the multi-week process of teaching a model on huge data sets. That's what those massive centralized clusters have been doing for 2 years. Inference is using the trained model. Every time you ask an AI chatbot something, that's inference. Inference happens billions of times a day at millisecond latency. Completely different workload. 3 things change when inference dominates. 1, inference has to be geographically distributed. A user in Paris doesn't want her query routed to Iowa and back. A self-driving car can't wait 200 milliseconds for a round trip. So inference moves to the edge. Regional data centers, telco facilities, the device itself. 2, inference economics favor smaller, cheaper, specialized chips. Google's TPUs, AMD's MI series, Broadcom's accelerators, custom ASICs. NVIDIA's Q2-Mote is genuinely thinner in inference than in training because the workload is more portable. 3, inference volume scales with user activity, not with model release cycles. So it grows continuously, and by the second half of this decade, it's going to dominate. The beneficiaries on the inference side are different. Synaptics on Edge AI, Microchip, ARM Holdings AMD, Equinix and Digital Realty on inference tier colocation, and Lumentum, Coherent, Ciena, Cisco on the optical interconnect that makes distributed inference work. And the most contrarian implication, NVIDIA's training dominance is well understood. Its inference position is less obviously dominant. Whether NVIDIA holds the inference market or cedes ground to Broadcom, AMD, and custom ASICs is the biggest open question on the silicon side from 2028 onward. Part 3. Reading the bottleneck in real time. All right, so how do you actually spot the next bottleneck before consensus does? There are 5 signals. None of them require non-public information. All of them show up in industry trade press and company disclosures. Signal 1. Lead time stretching. When the delivery quote for a piece of equipment goes from quarters to years, pricing power has already arrived. The equity market catches up 6 to 18 months later. So you want to watch lead times for HALEU enrichment contracts, modular electrical room delivery slots, and large water cooling components. Signal 2. Backlog growth that outpaces revenue. When backlog runs faster than current sales, that's the financial statement version of lead time stretching. GE Vernova's Grid Solutions, backlog up over 40% year over year. Quanta's backlog at 35 to 39 billion. When backlog to revenue exceeds 1.5 times and rising, with no cancellation noise, you're looking at a bottleneck owner. Signal 3. Slot pricing diverging from spot. When a vendor starts quoting future delivery at materially higher prices than current shipments, that's direct evidence of pricing power. Gas turbines in 2026 are the cleanest current example. Signal 4. Hyperscaler bypass behavior. When the biggest buyers in the world engineer around a bottleneck instead of waiting, the constraint is acute. Behind-the-meter PPAs were the bypass signal for grid interconnection. The next cycle signals to watch are hyperscalers pre-purchasing water rights, signing long-tenor HALEU offtake agreements, or funding modular contractor capacity directly. Signal 5. Customer concentration. When 60% or more of a supplier's new orders come from the same 4 or 6 hyperscalers, the cycle is mature. Demand quality is high, but you've also got the downside risk of a hyperscaler capex pause. That's the signal that tells you whether to lean in or start sizing down. On valuation, what does the multiple imply? Most of the names I'm about to give you have already had big rallies. So the question isn't what's the multiple. The question is, what does the current multiple imply has to be true? 3 anchors. First, only pay premium multiples for Tier 1 and Tier 2 moats with confirmed pricing power. ASML, Synopsys, TSMC, GE Vernova heavy turbines, Quanta Transmission, Howmet blades, Vertiv liquid cooling. These earn their multiples. Below that tier, premium multiples are renting growth that may not persist. Second, backlog visibility is a discount on the multiple, not a premium. A multi-year, multi-customer backlog with built-in price escalators is the cleanest evidence of demand quality. Names that combine backlog visibility through 2028 with cyclical industrial multiples, that's GE Vernova, that's Quanta, are arguably mispriced for reasons completely separate from any AI thesis. Third, cash flow is the reality check on every other metric. A 26 times price to sales on a cash-burning business is a fundamentally different asset class than a 38 times forward PE on a 60% grower with positive free cash flow. Prefer names where through-cycle cash flow funds capex and shareholder returns over names that depend on capital markets staying open. Part 4. Where to put capital in order. Okay, the whole point of this framework is to produce a ranked answer, not a basket of 35 names with equal weight. So here's how I'm ranking them, in tiers. Before the list, one conceptual note. There are 2 valid ways to make money in this supercycle. The first is to own compounders with a tailwind, businesses earning high and rising returns on capital with clear demand growth. The second is to own mispriced setups, situations where analysts haven't caught up to a demand pull-through that's already visible in the order book. These are different bets. They have to be sized differently. If you size a thesis bet like it's a quality compounder, you're carrying risks you haven't actually priced. Tier 1A, highest conviction, strong on both screens. Size largest here. Number 1, Comfort Systems, ticker FEX. The strongest single position in the entire chain. Return on invested capital has nearly doubled, from 5.9% to 11.5% over the past 2 years, and it's still accelerating. Operating margin went from 8.8% to 16.1%, while revenue grew 56%. Total debt of $145 million against an equity base in the tens of billions. Free cash flow conversion of 1.71 times. Beat earnings in 6 out of the last 6 quarters. Most recent EPS surprise plus 53%. The thesis is the Summit subsidiary doing factory-built modular construction. Exactly the labor bottleneck I described in Track 2. The multiple has begun to recognize this, but it hasn't caught the margin expansion or the runway. Best risk-adjusted position in the entire chain. Number 2, Howmet, ticker HWM. Textbook quality compounder with a Tier 1 sole source position. Only 3 companies in the world make industrial gas turbine blades. Howmet is the only public independent. Return on capital has improved every single quarter for 8 quarters straight. Gross margins from 31.5% to 36.9%. Net margin of 25.1%, the highest in the 11 name set I'm working with. EPS growth around 40% year over year for 6 straight quarters. The aerospace and defense backlog gives you a non-AI demand floor underneath the AI thesis. The price to earnings multiple looks rich on a static read, but the rate of EPS acceleration justifies it. Number 3, Quanta Services, ticker PWR, exceptional cash flow conversion, and it's structurally re-rating from a cyclical contractor to a recurring infrastructure compounder. 35 to 39 billion in backlog. Free cash flow to net income conversion of 3.72 times. Extraordinary for a construction firm. Operating margins doubled from 2.9 to 6.1% as the company scaled. Beat earnings 6 of 6 recent quarters. The thesis break signal is well defined. If gross margins compress below 13% for 2 consecutive quarters, the labor cost pass-through has failed. Absent that signal, the backlog math implies the re-rating continues. Number 4, GE Vernova, ticker GEV, strongest thesis in the entire article. Spans layers 2 and 3 of the power stack, turbines and grid. Backlog around 150 billion. Turbines sold out through 2028, 2029 slots already pricing higher. Service revenue compounding around 7% a year. Q1 2026 EPS up 126% year over year. The one caveat, GEV only spun out of GE in early 2024, so the financial quality history is only 2 years long. The thesis carries the weight here, and the quality data is directionally supportive, but not yet fully confirmed. That's why it ranks 4th in this tier rather than higher. If the next 4 quarters look like the last 2, this name moves up. Tier 1B strong thesis, but size these as revenue revision bets, not compounders. Number 5, EQT. The single biggest market is sleeping name in this whole framework. Largest U.S. natural gas producer. Sits 1 layer upstream of gas turbines sold out through 2028. But it's covered by energy sector analysts whose models don't include data center gas demand. Current ROIC of 1.1% and ROE of 1.3% look low, but those are the numbers that re-rate as the volume base steps up. Treat it as a thesis bet sized for asymmetric revenue revisions, not as a quality compounder. Number 6, Kinder Morgan, KMI. The defensive expression of the same idea. Largest U.S. natural gas pipeline network. Every cubic foot of gas moving from wellhead to a behind-the-meter generator crosses pipeline takeaway capacity, free cash flow of about $5 billion, the highest absolute number in my group. Lowest PE in the group at 24.4 times, 20.2% net margin, currently modeled by consensus as a steady yield midstream operator. For portfolios that want the gas supply thesis at lower volatility than EQT, KMI is the cleaner expression. Yield plus AI optionality. Tier 2, asymmetric setups with specific identifiable risks, smaller positions. Number 7, Vistra, VST, best of the smaller behind-the-meter nuclear names on quality. 18.3% return on equity, 26.6% operating margin, but $19.2 billion in debt and very volatile free cash flow. Q1 2026 EPS surprise of plus 411%. Then Q4 2025 missed by 77%. That's a bimodal outcome stock. If the BTM nuclear thesis works, big upside. If FERC moves against co-location, it falls further than CEG because of the smaller scale. Number 8, Constellation Energy, CEG, the scale leader of the BTM nuclear theme, largest U.S. nuclear fleet. The Microsoft 3 Mile Island restart is the marquee deal. But there's a new flag. The Calpine acquisition closed and pushed total debt from roughly $9 billion to $22.5 billion. That puts debt in the 7 to 8 times annual free cash flow range. Share price down 19.7% year-to-date reflects market skepticism about Calpine integration, plus the FERC overhang. The TMI thesis is intact. The Calpine risk is real and new, smaller position than the thesis alone would suggest. Number 9, Synopsys, SNPS. The ANSYS integration hit operating margins from 23% to 13% and ROIC from 10.6 to 0.1%. The market is reading this as structural when it's transitory. The EDA duopoly with Cadence is intact. The $11 billion backlog is intact. Gross margins remain at 74%, should resolve over 18 to 24 months. The flag is the $10 billion in debt taken on for the deal, which makes the EV to EBITDA the richest in my group on a near-zero denominator. Thesis is right, timing is longer than the original article gave it credit for. Number 10, Powell Industries, POWL, strongest year-to-date performer at plus 137%, but ROIC has decelerated from a mid-2024 peak of 11% down to 6.7%. Q2 2026 missed earnings by 67% year-over-year. Thesis intact. Medium voltage, switchgear, backlog tripled since 2022. Data centers 15% of mix. But the deceleration is the first real warning sign in the data. Zero debt is genuinely impressive. Size smaller than the parabolic chart suggests. Watch the next 2 quarters. The speculative tier, option size positions for 2028 plus. Centrus Energy, LEU, the functional sole source US HALEU producer. If small modular reactor deployment proceeds on the publicly stated timelines, Centrus has Tier 1 sole source pricing power. If those timelines slip, the thesis weakens. Option size, not position size. BWX Technologies, BWXT. Navy nuclear demand of about $2 billion a year gives you a downside hedge that pure SMR developers don't have. The SMR upside is the asymmetric setup, more defensive than Centrus. MP Materials, MP, the only fully integrated U.S. rare earths producer, defense contracts as a demand floor, high beta to U.S.-China policy, Oklo, NuScale, nanonuclear. All pre-revenue SMR or microreactor developers. The setup is real but binary. Each one either commercializes at scale by 2028 to 2030, or it doesn't. None of these should be more than a single-digit % allocation. The base rate for early-stage capital-intensive technology developers is that timelines slip and dilution is required. Plan for that. And what to size carefully or just avoid. NVIDIA. Still the dominant accelerator franchise. Forward PE of 38.7 times. Not stretched on traditional metrics. But the slope of growth deceleration is the most important variable for the entire silicon stack. Hold, don't size up at current levels. Lumentum. The 1,850% rally has already happened. The remaining upside depends on indium phosphide capacity staying tight through 2027. That's a duration of shortage trade, not a structural rent extraction one. Take some off. Don't chase. Broadcom, trailing PE above 100 times in the VMware-related debt are both real. Custom ASIC franchise with Google is genuine, but the multiple already capitalizes a lot of it. CoreWeave, Nebius, Applied Digital, Core Scientific, IREN. These are CapEx consumers, not CapEx beneficiaries. Their economics require continued, unbroken hyperscaler GPU deployment, plus open capital markets to fund their own buildouts. The asymmetry runs the wrong way. If the supercycle pauses even briefly, these names suffer disproportionately. Not long candidates. Celestica, 53 times PE on a contract manufacturer where the top two customers are 39% of revenue, and insiders sold $150 million of stock in a single week. Avoid. The bottom line. Let me tie this all together in one paragraph. The AI build-out is no longer primarily a semiconductor cycle. It is an energy and infrastructure supercycle. The companies that own the constrained resource, a wellhead, a pipeline, a gas turbine slot, a substation, a nuclear reactor, eventually a HALEU enrichment cascade, those companies command pricing power and earn durable economic rent. The companies queuing on the other side pay it, and the further upstream the bottleneck, the more durable the rent extraction. That principle worked through GPUs and memory. It works at the grid and turbine layer right now. It scales backward through gas supply today, and it scales forward through nuclear baseload, water, fuel cycle, modular labor, and the inference shift that will define the next phase. The highest conviction names where both the mispricing thesis and the underlying financial quality reinforce each other are, in order, Comfort Systems, Howmet, Quanta Services, and GE Vernova. Those are the compounders with a tailwind. Size them largest. EQT and Kinder Morgan are the next band. Thesis bets sized for asymmetric revenue revisions. Vistra, Constellation, Synopsys, and Powell sit in Tier 2 with specific risks identified by the quality data. Centrus, BWXT, MP Materials, and the pre-revenue SMR names are option-sized positions for 2028 and beyond. And the names whose investment case depends entirely on uninterrupted hyperscaler CapEx without a structural moat, the neoclouds, the Bitcoin to AI pivots, the contract manufacturers. Those should be avoided or sized as the asymmetric risks they actually are. If you take one idea away from this episode, let it be this. Capital flows to the constraint. The constraint moves. The equity market lags by 6 to 18 months. Your job as an investor is to see where it's moving to next. That's it for today. Thanks for listening. If this was useful, share it with someone who thinks AI investing is still about GPS.